Hello, hi, I'm Nick Burgess. I'm a quant analyst. I work in financial services and I specialize in interest rates and fixed income products. Today I'm going to talk to you about bond futures and I'm going to show you the Bloomberg screen, what bond futures look like. I'm going to show you how they price, how they operate, how they work, and potential trading strategies they used with bond futures. So without further ado, let's jump into the Bloomberg. Any materials I share will be in the links below, and let's continue. So I'm going to share the screen. I'll take a look at Bloomberg, and we'll go from there. Give me 1 second. Brilliant. Okay, so this is a Bloomberg terminal, and to find a U.S. Treasury bond future, for example, a 10-year note, you type TY for Treasury, which we do here, TY, and then you have to specify the contract. So you normally have a one letter for the month and one letter representing the year, and the month symbols there H, M, U, and Z. H is March, M is June, U is September, and Z is December, and then the digit represents the year, the last digit of the year. So if you don't remember those symbols, you can just say type A, and that means the active contract, which is typically the first contract. You can sort of see it here, TYA commodity, and that's the US Treasury note, 10-year active contract. This is a bond future. So let's click on that. This will bring up the menu or the menu dashboard in Bloomberg. And you can see all the price discovery pages and everything else, charts and all the rest of it. And the thing that's most useful for us is the futures analytics sort of screen. And we're going to look at this DLV screen, which is the cheapest to deliver bond. And I'll explain how I'll use this to explain how bond futures work. Okay, so when you're buying a bond future, investment banks and the big players on Wall Street, they're using bond futures for many purposes. But one of the speculative reasons is if you want to indirectly sort of bet on interest rates directly, then we can do that using bond futures. If you are long or buying a bond future, you're purchasing a bond at a future date, and the expiry date is sort of determined by the contract. So this is the June contract, which you can sort of see here, June 25. And if you quickly look at the contract table, which is CT, which you can get from the menu screen, the one we just looked at, you can see all the bond futures contracts. You've got June, September, December, and these are the delivery months where you will be purchasing your bond. And you can choose to go long and buy, or you can sort of sell your bonds. So you can bet on bonds going up or down in the future. And it's a great way to sort of speculate on interest rate movements in the market without sort of betting, without taking an interest rate position directly. Now, what you can sort of see is the volume traded is all pretty much on the open interest. It's all on the the nearest bond future, which currently is the June 25 contract, and there's not much volume in the other contracts, so that's pretty normal. The active or the front futures contract is where all the volume is, and then as you get closer to maturity, you can either choose to make delivery, or so if you buy in the future, you're going to receive the bond. If you're selling, you're going to deliver the bond. Um, or as there's a physical delivery, or you can unwind before the expiry month, the delivery month, and roll the contract. And a lot of people do roll the contract. Now, let's have a look at this June 25, which is so when you click on one of these descriptions, you'll see that the tickers at the top will change. It'll be a bit slow, and you'll see all the price information. So we're going to click on June 25, and then we're going to go into the delivery page, DLV, cheapest to deliver. Now, the way that bond futures are working, we did mention we can sort of use them to purchase a bond in the future and potentially speculate on bond prices. But the other thing people use bond futures for is to hedge funds in particular. There's going to be a cash futures basis trade, and what does that mean? It means that we look at the cash price of the bond, today's price of the bond, will converge to the futures price at the expiry of the futures contract at maturity, because they become the same thing. So you have to deliver that bond. The cheapest deliver bond gets delivered, and the futures contract and the and the bond price will converge. And so the spread, the difference between the cash bond and the future price, we do know that that is going to converge and become the same thing. So a lot of people sort of bet on make a pretty certain bet on those prices converging. So the cash bond will become the futures price. So it's a lot of hedge funds are very active in that space now, and one of the things to mention is that the size of the contract. So when you purchase a bond future, one bond future gives you the contract value for that one future is $100,000 for TY for the 10-year Treasury bonds. It can be different for different contracts, but for the 10-year Treasury future, it's $100,000, and that's sort of equivalent to $100,000 of the cash bond at the prevailing sort of market price. Now, we go into this DLV page to look at the cheapest to deliver. Why are we doing that? So the way the bonds are working is that there will be a basket of bonds that are sort of loosely representing the 10-year Treasury bond. And one of those bonds is going to be delivered to you at the maturity of the futures contract, and the seller of the futures contract gets to decide which bond to deliver, and they always deliver the cheapest. And so hence it's called the cheapest to deliver page, or the delivery page. It's trying to give you the information about which bond's the cheapest to deliver. And so when hedge funds are trading the cash futures basis, they typically will buy the cheapest to deliver bond, sell the future, and they're hoping that the prices, well, they're expecting that the prices converge, and nearly always they do. There's some caveat. Now, when the bond basket also has this thing called a conversion factor. And what that means is that all these bonds in the basket, they're normalized and they're converted, the prices are converted in such a way that these bonds are loosely sort of representing a bond that pays a yield of 6%. That's the reference yield. And these conversion factors then are adjusting the prices, the forward prices, in such a way that they in that these bonds are normalized, are fair in that sense. They're making it a fair game. Those conversion factors are set at the beginning of the futures contract before trading begins, and the bond basket is the same as well. So all of that is set up front, doesn't change. And so that's the conversion factor. And as bond yields change, sometimes the cheapest to deliver bond changes. And loosely speaking, you could sort of say when yields are around 6%, they tend to, if yields are moving in a parallel shifted sort of fashion, you would definitely expect a shift, a change in cheapest to deliver bond around 6%. And depending on the shape and the slope of yield curves as well, bond yield curves, you can expect sometimes to have multiple shifts for different yields and different times in the market. So the cheapest to deliver bond can move around. Now, when bond yields have low volatility, the cash futures basis trade generally works very, very well. When there's high volatility in the market and the cheapest deliver is changing, then it can mean that you need to readjust your position. And that volatility can cause a lot of problems in terms of having a profitable trading strategy that involves trading the cash futures basis. So low volatility in yields is a great time to do the trade. Now, how does the pricing work? So the pricing works is that in this way. How do you get the bond futures price? Now, the futures price is quoting on exchange. So you can say, what's the point of pricing anything? It's just a number that's trading in the market, very much like bond yield, bond price. But we need to know, we need to be able to price the bond future and sort of almost replicate that price, because we're interested in the dynamics of a bond future. We're interested in how the risk works. We're interested in how the behavior. We want to know about the hedging. So knowing the price is just not enough. So we calibrate our bond basket, and price the bond future versus to extract more information about the hedging, extract more information about the trading strategy, and and the risks involved. So what we see sort of here is that we got a bond basket for the June 2025 Treasury futures. It's 10-year futures, and all of these futures they have to be they have to have a certain residual maturity of around 8 years. So all these bonds are very sort of closely together in terms of maturity. They may have different coupons, but they're all sort of similar maturities, and there's some rules around that which you can find on the CME website. Now, the prices we see here, these are bonds, treasury bonds trading in 32s typically, but you sometimes have these fractionals on the end on top of those 32s. So this one would mean 103 and 1032s plus a quarter, just to confuse everybody. And this plus sign down here, that means 1 over 64, you add that on. So this would be 95. And I think we can sort of click here to show it in decimals. So you can sort of see it here, which is so much easier, but it's quite conventional to sort of see it quoted fractionals. Now, so we've talked about, so these are the cash bond prices, and the way that we would replicate the futures price and extract all this information for risk purposes, is that you start with the cash bond price, the today's price of the bond, and then the bonds will grow at an implied repo rate, and basically that's like a kind of growth factor. And so this for the bond to match the futures price, then you take the cash value of today's value of the bond, you grow it at this implied repo rate, and you have a forward value of your bond. And then once you have a forward value of the bond, you have to adjust it by this conversion factor. So you divide by the conversion factor, and that will then match the futures price, which you see at the top here. It's currently at 112 and 532s plus 1 over 64, this confusing plus symbol. So that will, and so it's giving us all the implied repo rates for these bonds to grow to match the futures price, and so they can be positive and negative. And the cheapest to deliver bond always has the highest implied repo rate. And what that means is that the bond is equivalently, so when you incorporate the conversion factor, the cash bond is low, and it needs to grow it needs a higher growth rate to reach the future value of our futures contract, of the forward value of our bond, the adjusted forward value. So because it needs to grow a lot more, the highest repo rate is sort of telling us that the underlying bond needs to grow at a much higher rate to match our futures price. That's because the price is so low, and therefore that's the cheapest to deliver bond. So the highest repo rates correspond to the cheapest to deliver bonds. So in this case, it's bond number one. They are sorted in that order, actually. Now, the other thing to sort of mention is that there's actual repo rate. So the actual repo rate is the financing cost for these bonds in the US Treasury market. You can see they're all 4.302%. These bonds are all very similar, of very similar maturities, and sort of kind of almost equivalent for our futures contract. They're not exactly equivalent, but these actual repo rates, they're all the same for every bond. They're not always the case, but for US Treasuries, they typically are. So this is the actual financing rate in the market, which is the actual repo rate. These are reverse repo rates if you're purchasing the bond. And the implied repo is something quite different. It's just very specific to bond futures, and this is this growth factor so that our cash price matches the futures price. So they're two very different things, not to be confused. Now we've got two other things to mention. We've got gross basis and net basis. This is more related to trading strategies around sort of holding the cash bond, being long the cash bond, and delivering the futures contract. And so the gross basis, that's showing us what's the difference between the cash bond price and the forward bond price. So you're seeing that in 30 seconds. And then the net basis is the same thing. It's gross basis, but it's subtracting cost of carry. Now, cost of carry here typically means what income are you going to get from holding the bond, minus any sort of repo financing, reverse repo interest that you might have to pay. So when you're buying the bond in a bond basis, in a cash futures basis trade, you typically want to be long the bond, and then you want to sort of sell the future. The prices are going to converge, and you're going to benefit from that convergence, which is sort of captured partly in sort of the gross basis. So the gross basis is showing you how much potentially what you're looking to sort of make from potentially make from the convergence in bond price, the cash bond price for the future. And then the net basis is going to incorporate sort of the financing cost. It's just gross basis minus the cost of carry. And you're looking for a positive cost of carry. And what that means is the income that you're going to be receiving from your treasuries, you want that to ideally be you want to get more income from your bond, from holding the bond to the maturity of the futures contract than what you're paying in reverse repo finance costs. Um, so you want that cost of carry to be positive, ideally. So you'll have two sources of income. You'll have the income coming from the positive carry, and you'll also then looking for income from the as the spreads converge from your cash bond and your futures bond, forward bond, and the futures price. Um, so that's captured in net basis, and the you could obviously have this situation where the net basis is negative, but you want it to be positive to work in your favor. Now, the risks that you have sort of when you're trading sort of bond futures, is that yes, okay, the upside for you is that it's you know that in a low yield, a bond yield volatility sort of environment, where interest rates are stable, that you just you let your cash bond price converge to the forward or futures price, and you just take all of that cash, all of that benefit is yours. So you take that as profit, and then on the second source of income, then is if you have a positive carry, you'll just be benefiting, and sort of as time moves on, you'll be accumulating, or you'll be collecting coupons, and your financing cost for funding that position is lower than the coupons that you're receiving. So that's fantastic. So there's two nice sources of income. So that's kind of a summary of the bond futures contract, and the risks would be in trading the cash futures basis. The risks are basically that what happens if there's more volatility in the market or interest rates are moving around, and that's going to affect which bond is the cheapest to deliver. And then your potential your trading strategy, that spread is then no longer valid, because you'll need to use a different the cheapest to deliver bond will be different. You'll be holding the wrong bond, and you might have to readjust your position at cost. Um, the other thing is that when you switch on to a new cheapest to deliver, maybe the spread looks different. It should still converge, but maybe if cheapest deliver is jumping around, um, that's going to affect how the behavior of that spread and whether it's still profitable. Also, then you might find the net basis changes, and the cost of carry changes as well. So you might not be in a positive carry anymore. You might be different. Now, the other thing that can happen is if interest rates moving around a lot, then the repo rate financing rates can move with them, and those bonds can also the repo. When you reverse repo to go long, the repo counterparty might recall your bond. So repos are normally done on a daily basis to finance your bond, or reverse repo. But you're doing that on a daily basis, and you're rolling your financing every day, and those repo rates can change. And they can spike up, and that's a risk then to your trading strategy. So you're looking really, ideally, you don't want your bonds to be in high demand. You don't want there to be a squeeze. You don't want high volatility sort of affecting the cheapest to deliver bonds. So you're looking for sort of calm market environments to trade such strategies. It's a very profitable trading strategy for hedge funds. It's a clear winner when volatility is not crazy. When there can be some volatility, that's fine. But when there's a lot of volatility, you find that you're jumping around between the different cheapest to deliver bonds. Now, if you were to simulate all the different scenarios that bonds can have, you probably find that there's going to be about four, probably out of this list of bonds that are very closely, very similar durations, similar maturities. You're going to find there's probably only four of these bonds that are possible candidates for cheapest to deliver bonds. So it's not like you have 11 different bonds that could be cheapest to deliver. It's when you account for different market scenarios, it's probably only about between two and four bonds that can be cheapest to deliver. So the risk of switching to a different bond and having to sort of reassign your position to come out of one bond, sell one bond, and put in a different one. Maybe the risks there aren't so bad, but in high volatility markets like what we've seen with the Trump 2 situations like a week or two ago, where markets were very, very volatile and sort of big jumps in yields and interest rates, then obviously that's going to have a big impact on your position. And we saw massive sell-off by hedge funds in that scenario, but that's highly unusual. But the bond basis The bond futures basis trading strategy is a highly successful trading strategy. It's a very stable sort of source of income for hedge funds, but obviously it's not for retail investors. It's typically for hedge funds because the contract size is $100,000 per future. So it's for the big players. So I hope you enjoyed the chat. Please subscribe to my channel. If there's anything further you want to know, please reach out and I'd be delighted to talk to you. Thank you. Bye.